From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for November 7th, 2025. Your Milwaukee Bucks host the Bulls at Fiserv. It's always fun when the Bulls come into town. The Packers have an important Monday night game. The Philadelphia Eagles come to Lambeau. And the third annual Art Fling, artists of every persuasion, will be at Puddler's Hall on the south side. If you can't find it there, it doesn't exist. Okay, here we go. Kim Kardashian has a law degree now, but no thanks to ChatGPT. She said she used the AI to help her with exams, and it gave her the wrong answers. She failed the exam. Even AI doesn't like Kim Kardashian. Did you ever wish your child was not such a fussy eater? Well, be careful what you wish for. This almost 2-year-old boy is eating everything in sight, literally. He started off eating kids' books as a baby. Now the kid eats sand by the handful. He eats rugs as well as furniture, including his own cot. As his mom said, he's the reason we can't have nice things. And from the art world, remember last year when someone paid $6.2 million for banana duct tape to a wall? Well, the artist is back. This time he has a fully functional 18-karat gold toilet, weighing in at 223 pounds. And at 223 pounds, the gold is valued at $10 million. Sotheby's of London is putting it on the auction block later this year. I can only imagine what the artist is using for toilet paper. On the podcast today, we have Adam Baley, Joel Driesang, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Max. A tough week overall for the stock market, although a Friday afternoon rally certainly helped recover some of the loss. NASDAQ down 3% this week. That's down 720 points, just above 23,000 today to close at 23,005. The S&P 500 down 1.6% this week, although did turn positive Friday afternoon for the day. Closed today at 67.29, and the Dow Jones Industrial Average up 75 points on the day, but down 576 on the week to close down 1.2% for the year. NASDAQ up 19.7, the S&P up 15.6, and the Dow up 11.9. Adam, maybe this week's market performance, the place to start. Clearly a kind of tough stretch here, getting through the bulk of earnings season, still absent a lot of economic data. Feels like maybe just a reality check on some of the high valuations right now, perhaps investors looking to take some profit?
Yeah, well said. I think it's just a reminder that trees don't grow to the sky, and markets have been going straight up for the last several years, and valuations are starting to get stretched and strained, and at some point you just got to pause and catch your breath after sprinting so far, so fast, so long, and you're starting to see valuations really look into the calculations on how investors are thinking about this and backing off in terms of this week. But valuations on forward-looking PE on the S&P 500 is give or take around 23 times future earnings, and that's expensive. And we've only been at this level a handful of times in our market history. The only time we've really been above this in terms of just lofty valuations was like at the peak of the dot-com bubble. Just to kind of give you some context at what 23 times future earnings, that's rich for my blood.
Yeah, it turns into, if you flip it on its head, it turns into an earnings yield of a little more than 4.33%. So in pretty basic terms, compared to what you could get in even fairly high-quality bond offerings, you're getting a pretty similar yield on bonds now relative to what you can get in the stock market and putting $1 in the S&P 500. And so I think it is continuing to kind of give investors pause as to how much more do we want to enrich stocks at these levels. No shortage of articles from the Wall Street Journal, kind of piggybacking on some of what JP Morgan and Vanguard were writing over the summer about their capital market assumptions looking out over the next 5 or 10 years. I think it's fair to say that, the outsized returns we've seen the last few years may be slowing down a bit from here, but also a reminder that bull markets don't just die because they've gotten old, and that stocks don't immediately surrender to the laws of gravity. And so I think there is a lot of support, even despite some of that uncertainty. And even though we're going to see some of these periods of time, a week here, a week there, in which things pull back a little bit, we are still in a market in which it has largely been risk on.
Yeah, go back to those long-term market assumptions. The one from J.P. Morgan is one of my favorite. I love to go back and just kind of cite chapter and verse in history, like, when we've been kind of here, what can we expect going forward? And when we have been at forward PEs at 22, 23 times future earnings, you look back in the past on, okay, well, after that, what was the subsequent 5-year annualized return after starting for such lofty prices? And JP Morgan put together their research, and the average annualized subsequent returns are close to zero. So it's just a reminder that maybe we have gotten a lot of returns just truncated and compressed into the last few years. And with valuations as high as they are, the market is likely to either one, pull back substantially, or two, just trade sideways for a while and allow earnings to catch up with today's prices.
I think you hit on an interesting point there, Adam, and that is that to get a 5-year or 10-year average that's maybe a little worse than long-term averages, or even significantly worse than long-term averages, it doesn't mean that every one of those 5 or 10 years is a bad number. It might mean that you get one bad number somewhere along the way, especially early on. That can really kind of alter the timing of those returns, can kind of really alter your experience. And so I think it speaks to the importance of the balance that we preach. I think it speaks to the importance of having some dry powder, either in shorter term, high quality investments or directly in cash, so that if we do see that stretch sooner rather than later, well, good news, if stocks are down 15 or 20%, it means they're 15 or 20% cheaper. Bad news, you're down 15 or 20%. But again, if you've got some options, some optionality, some ability to move into the stock market, well, okay, that's the whole role that balance is supposed to play. Give us the opportunity to make those changes when they come.
And there's lots of compelling options outside of just domestic stocks. I mean, I mentioned the S&P 500, but cash these days is offering competitive returns. Safer assets are offering competitive returns. You can still get around 4% yield on a money market, on a high-quality, short, intermediate-term bond fund, somewhere around 5.5%-ish, which is bigger than the earnings yield on the S&P 500. And then you also look overseas, because there's more businesses than just here in the United States, but there's a lot of very well-run, very profitable businesses trading at more reasonable prices in Europe or developed Asia or Japan.
And sometimes those businesses aren't always in countries you might otherwise want to participate in, but it doesn't mean they're bad businesses. And a reminder that given how global markets are at this point in time, a lot of their sales aren't coming from those places anyways. And so I think you're right to point out here's some other opportunities that are out there. In the interim, I think it's safe to say, or fair to say, that it doesn't mean stocks turn south tomorrow. It doesn't mean that we suddenly see a downturn. It might just mean that, okay, we need to be a little more cautious, as we have been. I think a lot of conversation, Adam, on what's happened with tariffs and the administration in front of the Supreme Court this week to talk about the constitutionality of Trump's tariffs, the way they were enacted. I got some questions from clients on, well, if we find out that these tariffs were not constitutional, that they shouldn't be allowed, what's that going to mean for stocks? The assumption, I think, early on was, well, maybe that's another kind of, okay, now things will be easier for businesses to operate. I think maybe you and I might argue it wouldn't be quite so simple if we find out, at least in a heartbeat, that all of a sudden these tariffs aren't quite what we thought.
Yeah, not so simple is the phrase. This is far more nuanced and far more complex. I've seen some legal arguments on just, what if these are declared unconstitutional. There's lots more other paths for tariffs to continue in a similar manner. And I think it's clear that the current administration is willing to use these as a policy tool for more long-term than just, for a few months. So I think we all have to be prepared that these could stick around for quite some time.
Well, what's interesting to me, we use that term tool. I wouldn't put it past the administration to find new tools, right? That we can do a very, very good job of understanding what this current tool is and how it's being used. But if you take it out of the administration's hands, what new tools are they going to find, and what creative ways are they going to find to use them? And so I think it is pretty reasonable to assume that no matter how the Supreme Court finds on this particular case, that it'll be something else down the road that we're challenging again for whatever reason. And so I don't think businesses have the clarity or the certainty that perhaps we're talking about. And Joel, part of what has led to that lack of certainty has been this ongoing government shutdown. We did not get a whole bunch more economic data this week that could have potentially at least told us a little bit about where we are. Still kind of feeling through the dark here to figure out what the labor market looks like in particular.
That's right, Kyle. We're expecting to get the October report on jobs through payroll numbers and through household interviews on unemployment. That's a really big report that comes out once a month. It's the second month in a row that we're missing. So those are the sorts of reports that people like the governors for the Federal Reserve Board use for making decisions. And some of those decisions are really big, like how much should they cut interest rates and when should they stop? So, we don't have those numbers. In fact, the people who collect those numbers aren't even working. So there are questions that I have about whether we're even going to catch up to find out what those numbers should have been. And however that lack of data catches up with policymakers, decision makers later on.
Yeah, whenever government does get back to work, they better publish these economic reports like ASAP, because I really want to see them. I don't like the idea of flying blind or even the possibility of continuing to fly blind with some of the core economic information that we need. And you take a look at the reports that should have come out this week, but we don't, right? Construction spending, factory orders, trade deficit, job openings, worker productivity, initial claims for unemployment, non-farm payroll, unemployment rate. I mean, these are critical things that we really need to know to assess the health and wellness of the United States economy, and they're just lacking at the moment. I mean, we can kind of piece together with other information, but it's just not the gold standard of the usual information we're used to.
Adam, there are more reports out there. A lot of it is private companies who have their own reasons for putting numbers together. And there were some things on employment this week, for instance, from ADP, which is a payroll company, and they come out every month looking at private employers based on some 26 million employees data that they have. And they came out to say that they think that the private employers created 42,000 jobs in October, which is not all that great considering the hundreds of thousands that we've added per month up until a few months ago. But they're still adding jobs, which is a good sign. We had numbers from the Institute for Supply Management, both for their manufacturing index and for their service sector index. Both of those showed employment down. Their components for employment for the manufacturing index was down for the 9th month in a row. For the service index was down for the 5th month in a row. We had numbers from Challenger, Gray, and Christmas, which is an outplacement company. And they've figured out that what they do is they look at announcements that companies make on layoffs, and they put those all together, and they said that there have been more than 1 million announced layoffs so far this year through October, and that would be the highest since 2003. So there are various signs that employment isn't going all that well, but it's more weakening than it is going south. It's more, there is a strength that's weakening than it is that things are getting worse.
And all of those really do play into the sentiment of consumers here in the United States, which we did get this week. Maybe, Joel, can you give us some more information on consumer
sure.
sentiment?
And again, that's a private thing. It's for the University of Michigan does surveys, and they come out twice a month, and this is a preliminary look at the November sentiment for consumers, and by the end of the month that might change, but they basically said that consumers are really kind of leery of both the shutdown and the tariffs, that they're concerned about high inflation, high prices. They're also concerned about all of the sorts of things that we're seeing more of with the government shutdown, with food availability, with flight delays, all those sorts of things.
One of the reasons why we focus on consumer sentiment, I realize it's a squishy number because it's an emotional number, but it helps to get inside the minds of consumers and do they have a propensity to continue to spend, because consumer spending makes up 70% of our economy. And historically, there's been a sizable disconnect between what consumers say and feel and what they ultimately do with their money. But the question remains, if sentiment remains this low for so long, will it impact consumer spending? We haven't really seen it yet, but the question remains, as having such depressed levels of sentiment, will it impact future spending?
And Adam, we've had more questions about that the last couple of years, where consumers have said they're really gloomy, but they're still spending money. We did have a number today that came from the Federal Reserve, which is still functioning, and the Federal Reserve showed that for the month of September, that credit card debt went up, but at a very low rate. And that's been, it's about 3.2% lower, that debt is, than it was in October when it's last peaked. And that's a number that, if you look at the charts, that consumer credit outstanding keeps going up. That credit card use and the debt that's outstanding from that keeps going up. And that's sort of seen as a sign of the willingness of consumers to borrow money to keep spending. So the fact that it went down a year ago and it's basically been going sideways most of 2025, and that might suggest that consumers are not that confident about spending money anymore.
It may also suggest that there's $72 trillion sitting in baby boomer balance sheets, right? And so there is cash there that may help to support some spending that keeps those outstanding revolving debt balances a little lower as well. And I think it has especially been reflective of some of the differences we've seen between older generations or more mature generations, credit ratings, their usage of credit, and some of what we've seen in some of the younger generations lately with some deterioration of credit quality, some delinquent auto loans in the younger generations, while we haven't seen that same development as significantly coming from the boomers and maybe the cohorts that followed immediately thereafter.
Another interesting note from the consumer sentiment report today, Kyle, was that stockholders are the least gloomy about the economy. They feel better about their own personal finances. They feel better about current business conditions because the market's been
that
up.
tends to happen after things go up so fast. You feel more confident, and it does play into like the wealth effect too, right? Where you see your wealth holdings, whether it be the value of your home or the value of your stock portfolio, go up. You just feel more confident in spending your income. We call that the wealth effect.
Well, thank everybody around the table today for working despite the government continuing to be shut down. We're doing our part, if nothing else. We enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.